Got it. So really quickly, where's the Dow trading right now?
Dow is down 78 points.
No kidding. Oh my God. Anything going on? NAFTA blowing up? Anything in the Straits of Hormuz? Any political instability, or is it just profit taking because the market's been on the screen?
See the trade war with China?
Potentially. Okay. And then I would go straight from stocks and then jump over oil and gold and go straight to bonds. So what's happening right now? The stock market's selling off, and they're probably selling stock and going into bonds. Bond prices are going up and interest rates are going down. Last time I looked, the 10-year Treasury was at 2.88 at the beginning of the week. So where's it trading right now?
284.
284, so it's down. Okay. So people are going into bonds. Either they're going into bonds because they're taking profits from the stock market, or they're going into bonds because they're scared, or they're going into bonds because they fear something. We're talking a lot about the yield curve right now. People are kind of freaking out about the yield curve. It's the flattest it's been in 9 years, and almost every expert in the field right now is forecasting an inversion of the curve in less than 12 months. And we talked about it in 123. Once the yield curve inverts, the stock market peaks in less than 12 months, when we're in a recession in less than 24. If you go back to 1970, 1955, you go back to 1930, you go back 100 years. Yield curve is the #1 predictor for a recession. Okay. And it looks like we're going to pump out about 1.2 trillion in deficit because of the tax cuts. So that's going to be a lot of paper to absorb. A lot of the paper that's currently out there needs to be refinanced. There's probably another trillion or two that needs to be refinanced on the short end, and the Fed is going to be selling off 80 to 90 billion a month off of their balance sheet by the end of next year. And most of those securities and that paper is going to be on the short end of the curve. And the Fed's already said that they're going to raise interest rates 3 to 4 times over the next 12 months at 25 basis point clips. And if they go 2 more 25 basis point clips, the curve's going to invert. It's the closest we've been in 9 years. Okay? So this is just the reality of the situation. Where's oil trading right now? Per barrel. Is it up or down? I think it's down from 70, but it's still high. It's up about 50% since last summer. Okay. Where's gold per ounce?
1207.
Yeah, it's been in basically a trading range for quite some time. You'd think gold prices would have gone up faster and higher over the last 2 months with the 4.1 GDP that just came out, and the GDP deflator is now pegged at 2%, which is basically the target for the Fed. And the CPI index is now around 3%, which is basically the target. And unemployment rates are now at what, 3.8, which is well below the 5%. So we're looking, and we're looking at a higher interest rate environment. So it's going to invert at some point, and that's what I've been talking about for the last 3 years. And then where is the U.S. dollar to the pound and the U.S. dollar to the euro? Have we appreciated or depreciated? Is it more expensive or is it cheaper? What's happening?
The pound is down against the dollar.
It's at the pound, so the dollar's appreciated.
Stronger, yeah.
Okay, so there's massive capital inflows right now. What's happening right now in the global markets? This is extremely important right now. What's happening today, right now, in the global emerging markets? Are you guys watching this stuff? Because it's all unfolding right now. Does anybody know what's going on in the emerging markets? Massive sell-off. The lira, is collapsing. The Turkish currency is collapsing. You're seeing an emerging market blow up in front of us. The currencies are starting to devalue significantly, which means their dollar-denominated debt is going to go through the roof. And people are selling off assets in the emerging markets right now. So it actually may be a good time at some point here to actually go long some of these emerging markets as they bottom out. But right now the spreads for a lot of this emerging market debt is extremely wide if you use either the U.S. yield curve or you use the German yield curve as a way to kind of calculate the risk premiums in the emerging markets. Yeah.
How do you stay on top of all of this? Like, what do you use?
I watch Bloomberg every morning, starting at 7 o'clock in the morning, and then I basically read. I go through my Seeking Alpha, and I kind of scan that stuff. But right now, I basically have subscribed to Bloomberg. I'll give you the passwords so you guys can watch it too. And I basically just watch that stuff. And then I go home and I watch Nightly Business Report to get the geopolitical stuff. And then I'm constantly looking at the markets, constantly. Trying to get a read on it, because as things start to change, it's gonna impact us, right? And you guys gotta be on top of this, stuff. So go up to the course website. And I've been working on the website. I'm almost done with it. I will probably have, by the weekend, I will have the templates that we used in the investments course last semester, so I'll give you the memos. And actually, I know Lee's got the templates, I know Kimberly's got the templates, I know Tyler's got the templates, because they were international, and there's some crossover there. And I'll provide you with the passive, the active, the target, portfolios, and we'll, you won't have to do a lot of the formatting of the report. You'll just do the analytics behind the report and then put that into the report for the PowerPoint presentation and the reports. Okay. But if you go up to the course website, right here, the equity sim. Okay. So each group, you guys gotta get your stock portfolios together as soon as possible. You have to pick your 25 stocks, and I would have some kind of sector strategy. I want to be in defense, high tech, maybe medical, electronics, or medical tech. Come up with some kind of portfolio strategy for the 25 stocks. And then what you're going to do within the presentation, that's going to be your strategy. We want X% of the portfolio in tech, in healthcare, in defense. So what I would do is go look at some exchange traded funds or some mutual funds, or come up with your own portfolio strategy and get those 25 stocks together as soon as possible. And then start working on the passive strategy worksheet. Okay. Yeah.
So we could have a portfolio that has high risk, or
you can do that if you want to.
Okay.
You can do that.
Sounds good.
So you could do a core, large cap, stabilized, dividend, lower returns but significantly lower risk kind of portfolio if you want to do institutional core portfolio strategy, or you could do a mid-cap strategy, or you could do a small cap strategy. But if you do a small cap strategy, a lot of those companies haven't been around for 10 years, so you're gonna have to backfill the numbers, okay, to do it. But it still can be done.
Right.
And Lee's gonna do a REIT portfolio with me, right? Anybody else want to do a real estate securities portfolio with me too? No? Yeah?
Yeah.
You want to do that too?
Oh, that's
Yeah, and we can publish a paper around that too.
That'd be awesome.
Okay. So once you've done that active strategy, the worksheet. Shoot, I don't have that. Once you do the active strategy, what you're going to do is go sign up for this right here. This equity sim. It's an equity simulation platform. I negotiated a deal with these guys. This is a startup company out of Toronto. And here's the deal. Once you get your 25 stocks, you're going to be trading the stocks over the semester. Okay? And if you put in technical analysis and fundamental securities analysis and other reasons why you're buying the stock and shorting the stock and buying and selling, trading the stock over time, the performance that your portfolio performance at the end of the semester will be reviewed by the company. Okay? And not everybody gets one of those. It's just for the team. So one team gets one of these things, and then I put the training manual and all the information already up on the website. Okay, the course website. So just for the teams. But here's the deal. You go to the last 2 pages of this template. It basically says, how does recruiting with Equity Sim work? So based off of your performance, you will be recruited, and they will reach out to you, and they will get you internships at some of the largest investment banks and broker-dealers out there. So we're competing against the Ivy League on this one. So if you do a good job and take the fundamental securities analysis template that we have available there to run your fundamental securities analysis to identify the firms that are going to be trading at a premium over the next 12 months, and you take the technical securities analysis, the moving average crossover, and identify the trades using that technique too. You now have two basic tools to be able to justify your trading that you're going to be conducting with the 25 cents. And then if you do a good job at the end of the semester, you'll alert these people, and they will give you a call, and they say, we've got people at B of A, at Wells, at Goldman, at JP, at Citi, that want to talk to you and give you an internship. So it's direct, your performance is directly related to the opportunity to get an internship at one of the top firms.
So who are these for? Team one?
Each team gets one of those pamphlets, and then what I've done is here's all the links. Here's a little intro video right here that I've also posted on there for you. And then here's the student users manual that I created this morning in the introduction to the platform. There's also contact information. If you're having problem logging in or logging into the class or having problems, trading or anything, they have a 24-hour hotline that you can call them and they'll totally walk you through it.
And this is the ID that we use?
That's the idea that I created for you guys. Okay. And what I'll probably do is if you guys can try to get that started or at least register and log that in as soon as possible, and then once you've created your portfolio, then you can start putting in the tickers and start building it here. This is the passive strategy with the back testing, and then this is the active trading that you're going to be conducting with the potential for an internship. Okay, so I added that in this semester. Okay, you guys. Now here's the deal. Okay, I can't have you talking during the lectures. Okay, it's been disrupted the last 2 classes. Okay, so I need you guys to stay focused, please. Okay. Then the next thing I did is I printed out and put on the website the security licensing opportunity that I also negotiated on your behalf through AXA Insurance Company. So if you're interested for $88, it actually comes out to be $119 with tax and shipping. This is the first level. This is the first half of the Series 7 exam. Okay, so I negotiated a deal for you guys to be able to get this for a total cost of $119. You pass this exam, you're guaranteed a job. Because anybody who goes into investment banking or securities analysis or wealth advisory or anything in the financial services and even private equity, you're going to need to take the first half of this exam, and we're making it, I'm offering it to you. And if you can't afford it and you're really good, I'll pay for it myself, okay? Because I believe in it that much. Now I've already printed out some of the information for this. Again, I didn't print out for everybody, because I don't think everybody's going to want to do it. If you're totally serious about taking this exam and working with me to pass it, take one of these. If you're not, then give it to somebody else. Don't waste the paper. Okay. So those are the 2 programs that I've negotiated over the summer for you guys. Okay. So huge employment opportunities if you do any one of these 2 tracks. Yeah.
How often do you have to take that test so you pass?
If you pass it, you never have to take it again.
When will we
And then you'll take the Series 7 after that. And here's the book that has all the material if you want to take a look and see what the content is that you're going to be learning to pass the exam.
So the toughness of this test is similar to...
Well, what they did was they split the Series 7. So they took the quant stuff and they split it into the second half, and they put the easy stuff and put it up front.
So it's not similar like the LSAT then, some people compare it to the LSAT.
No, this is the Series 7. It's like a CFA, mini CFA, basically. But they split it. FINRA, which is the Security Licensing Agency, basically split it in half. And then now anybody can take the first half. You don't have to be affiliated with a broker-dealer or a registered investment advisor. So it's a huge opportunity. And then AXA sponsoring us, and they gave us the deal on the test. And then what I'll do is the days that we're not really doing anything between 1 and 2 o'clock on Wednesdays, either in next door, or in this class. What I'll do is during the time periods of the finance club where we're not really doing anything, I will do a SIE training program, and we'll go through the content. Okay, so I'll help you pass the exam. Okay, so those are the 2 things that I felt were extremely important. Also on the website, I broke out all the materials you need for the pre-test. People who haven't taken the pretest or haven't taken my class, you need to be working with the other students that have taken the class so that they can help you work through the pretest. And I did expand the pretest, so it's not exactly the same as the one you took in 123, okay? And then the second part of the pretest is actually the quiz from 123. So for those of you who didn't take 123 from me, I may focus on some of that stuff, or maybe you come see me, make an appointment, excuse me, to come see me. And then that way, I'll walk you through those models so that you're not guessing or getting frustrated or anything like that. Each of the teams have to meet with me at least once during the semester. Okay, your team or your team members have to meet with me so I can audit the spreadsheets to make sure that you're on the right track. I don't want people floating out there, you know, not keeping up and being confused. If you're confused, ask people around you that have taken my classes, and then come see me, okay? Because I got to make sure that everything is correct and that the model's working, okay? All right. And then I expanded it so you can download the folders, you can download the presentations, you can download the Excel spreadsheets. You can, everything is basically available to you to be able to do the presentations that you need to do in the class. But we're also going to be doing two, which, how much time do we have today? What we're also going to do, is I'm also going to hand out these homework assignments. Okay. And then did everybody bring their book or have access to the book? You guys have access to the book? Okay. So these are the homework assignments that you're going to put up on the board. Maybe we don't do it this class, but next class, you know, read the homework assignment in the book, look at the solution, and then come in and put the maybe high level, the problem, you know, elements on the board, and then put the solution on the board. And then hand this back to me after you make the presentation. And this will be equivalent of the homework assignments. Okay. So this is, again, an active learning strategy that gets you engaged in the process. And then each of you will have an opportunity to make the presentation. For the longer problems, I put 2 lines under it so you can work in a group of 2. Because the problems are a little bit more complicated, and I didn't want to overburden the individual with it. What I did was I printed out, or I picked the homework problems that I thought were the most relevant from the chapters. And then what we'll do is, as we present the PowerPoint presentations, we'll also put the problems up on the board so that we're working through the mathematics. And then that way we're tracking, you know, the book. So we're going to learn all the book stuff, or at least the most important stuff from the book. And then we'll do the problems, we'll do the PowerPoints, and then we'll use the Excel spreadsheets to do the portfolio construction and performance benchmarking, and then we'll use the equity sim to be able to trade the securities. So the class will be done on two sides. Okay. So slowly over the years, you'll get the next. Or you can work with timer. Yeah, if there's two lines, we're under the name. If it says names and there's 2 lines, then you can work in a team. Okay, all right? So that's the book, that's the homeworks. So we do the problems, we have the spreadsheets, you gotta get the 25 stocks as soon as possible. You gotta set up your equity sim account and maybe start trading, you know, trading your stocks. And then using the intrinsic valuation methodologies and the technical trading methodologies, along with any news or financials, you'll start trading the securities and see how you do. So we'll be testing your portfolio performance based on the passive, the active, the target, fundamental securities analysis, and the technical securities analysis using the spreadsheets that I've developed and my students have developed. And then on the other side, we'll use the equity sim software to trade the securities to see the performance in a more dynamic, active role than just having it in passive. So you'll pretty much get everything from this class except for the derivative trading strategies. You will practice the derivative trades, or you will review the derivative trading strategies through the memos. And then what I'll do is one of the last pieces that I need to do is to build that second page of the memo that actually where you go onto the Chicago Mercantile Exchange or the Chicago Board of Trade, and you pull down basically the option contracts, the puts and the calls, and you pull down the forward contracts, the futures contracts, and the options on the futures contracts. And based off of your projection scenario for the indexes, the ETFs, or the stocks, you will put your trades in there based on the actual contracts that are being traded. And then we'll see over like in a month or 2 months or 3 months by the end of the semester, if you had exercised your options, if you would be in the money on the option contracts. So that's the application within the derivative component. Yes, sir. You're going to probably do that. How much time do we have? Can somebody help you do that? 40 minutes. So, and then how long is it going to take for you to go through your presentation? 15 minutes. And then how long is it going to go from yours? 15, 20. So basically a half hour. We got 40 minutes. So 10 minutes, basically, extra. Maybe 3 people. We might have that last 10 minutes. We could probably do a few problems. And then on Wednesday when we come back, I would say the first thing you do is you come in and you put the problems up on the board, and we just blow through them. Okay, and then we'll have chapters 3 and 4 done, and then I will give you 5 and 6, and then we'll come back on Friday, do the same thing, put the problems up, burn through those, do the presentations, and then if I can do it, the ideal situation is to burn through the PowerPoints and the problems in a half hour. And then I have at least 20 minutes or 30 minutes to lecture on other stuff, okay, more of the application, okay? And so if somebody wants to put up, one of their problems now, by the time these guys are done, we can, the 2 presentations are done, we can switch over, and then you can quickly do a few problems, on the board. And I'll let you guys take the initiative. And then after you're done presenting, you sign the problem sheet, and then you hand it back to me. And then at the end of the semester, at the quarter, at the quiz or the midterm or at the final, I'll add up and look at all the problems that you did, and that'll be your homework credit for the class and extra credit too. Okay? And it's not that hard because I already gave you the solution. So really, what you need to do is just look at the question, think through, learn it, and then come in and teach us that. And each problem shouldn't take more than 2 minutes. Okay, is that a plan? Is there anything that I'm missing in regards to the course design? Is there any gaps in it? No? I think I hit on pretty much everything. Okay, so when you guys are ready, are you chapter 2?
Yeah.
Okay, and then you're 3? Okay, so why don't you guys go first? And then if you guys want to put up maybe 3 or 4 problems, you want to borrow my book so you can look at it. Problems. And then how do most of you have the books? Are you doing an e-book? Are you doing a hard copy? Yeah, bring your books. And that way we can share it. All right. Thanks, everybody. Are you just plugging yourself in? Okay. Also, did everybody take pictures? Did everybody take pictures of the reports?
No.
Okay. So you need to take pictures of these reports.
Would I do that?
Because this is like the final product at the end of the semester. And it'll actually be even more extensive because I'm adding in some other layers to this class. So it'll even be a more amazing book by the time it's done. And then there's 2 options here for you. There's 2 options later on in the semester. Either you can do an intrinsic valuation of the stock, going through basically the exercise that we did in 123. Or what you can do is you can invent a financial product as a fintech firm. Okay, because I had some, in the international class, what was your product that you invented? Okay, Lee, what did you guys invent? Did you do like a global cryptocurrency portfolio or something like that?
Did a global REIT portfolio.
A what?
Global REIT portfolio.
Global real estate portfolio. So you have two choices. Either you can do the fundamental securities analysis, or you can do invent a financial product, a tool, and I can work with you on that. So, but a lot of people did cryptocurrency portfolios. Some people did impact investing portfolios. Some people did alternative investment portfolios with a cryptocurrency component to it, which is what I'm actually working on right now. So if anybody's interested in a renewable energy infrastructure program with a cryptocurrency component to it, that's what I'm working on right now. We could present it. That's what you want. Okay? All right. So what do you guys got?
Howdy, I'm Mike.
Austin. Jerry.
And we're presenting Chapter 2, Asset Classes and Financial Instruments. Here's a chapter overview. We have three different asset classes. We have the fixed income market, equity, and derivatives. Under the asset classes of fixed income market, we have two subsectors, the money markets and capital markets. The money market instruments consist of very short-term, liquid and low-risk debt securities that are usually highly marketable, and many of these securities trade in large denominations. Here are the major components of the money market. We have federal funds and repurchase agreements totaling up to about $3.75 trillion. And then small denomination time deposits and savings deposits, just under $9 trillion. And then large denomination time deposits at $1.86 trillion. And then treasury bills at $1.5 trillion. Commercial paper at just over $1 trillion. And money market mutual funds at $2.7 trillion. And money market mutual funds allow individuals to access So here are the money, I'm going to go over the money market securities. We have treasury bills, which are the most marketable of all money market instruments. They're short-term debt of the U.S. government. And you can get them at bid price, which is slightly lower price you would receive if you wanted to sell to a dealer. Or you can get them at ask price, which is the price you would have to pay to buy a T-bill from a securities dealer. And you can get it through a bank discount method, which means that the bill's discount from its maturity or face value would be annualized based on a 360-day period. Then we have certificates of deposit, which is a time deposit with the bank. Commercial paper, which is short-term unsecured debt of a company. We also have bankers' acceptances, which for a bank to buy a bank's customer to pay a sum of money on a future date. And then we have Eurodollars, which are dollar-denominated time deposits in banks outside the U.S., but not specifically to European banks. And then we have repos and reverses, which are short-term loans backed by government securities. And then federal funds, which are very short-term loans between banks. And then the money market securities are not completely free of default risk. The premium on bank certificate of deposits and the TEV spread, which is the difference between the LIBOR rate and the treasury bills, have often become greater during periods of financial crisis. Here's an example. That premium was increased with the economic crises of the OPEC incidences in the 1970s and 80s, and the Penn Square, the failure of Penn Square. And stock market crash as well, and the long-term capital management, the collapse of the long-term capital management in 1998, and the financial crisis in 2008 and 2009.
Alright. Now we're going to move on to the capital market, which is made up of treasury notes, treasury bonds, inflation protected securities, federal agency debt, international bonds, municipal bonds, and corporate bonds. So compared to the money market, the capital market are longer term investments. They're liquid and they're low risk, but not as much as the money market. Treasury notes and bonds. Treasury notes are usually have a 10-year maturity compared to bonds, which are in the 10 to 30-year range. And their par value is usually $1,000. Their interest is paid semi-annually, which is doubled to find the annual percentage rate over the APR. And the quotes are a percentage of par, so if you buy a bond for 98% of par, that would be $980. There are also inflation-protected treasury bonds, or TIPS, which are adjusted for inflation, so they're normally low risk. There are federal agency debt. The main agencies you've probably heard of are Fannie Mae, Freddie Mac, but there are also others, like Ginnie Mae and the Federal Home Loan Bank. International bonds, such as Eurobonds and Yankee bonds. Eurobonds are, the name is a bit confusing. They're called Eurobonds, but they're not limited to Europe. So for example, an American bond sold in Europe would be called a Euro-dollar bond. A Japanese bond sold in Europe would be called a Euro-yen bond. Municipal bonds. These are bonds similar to treasury bonds, but they're sold by state and local governments. Their interest is usually exempt from federal and a lot of the time from state and local tax as well. But the catch here is that you have to pay a capital gains tax. There are different types of municipal bonds: general obligation bonds. General obligation bonds are backed by the issuer, and there are revenue bonds, which is backed by the project revenues. So for example, if a company is trying to finance a project, they would sell revenue bonds and then pay from the revenue of that project. This is a chart showing the total debt outstanding from tax-exempt investments. You can see here that general obligation bonds make up the majority of the debt outstanding. So when you're trying to decide between a taxable and tax-exempt bond, it really just comes down to your tax rate that you pay. So, for example, different people have to pay different taxes depending on their income and whatnot. So if the taxable bond, which is R times 1 minus the tax rate, is greater than return on the municipal bond, then that would be a higher return, and vice versa. So if it's less than the return on the municipal bond, then you would be better off investing in municipal bonds. And here's a table showing the yield for different tax rates. Corporate bonds, these are sold by corporations, private firms. They're like treasury bonds in that they pay semi-annual interest payments, but they're higher risk than the government securities. And often these have options such as call options, so the corporations can buy back their bonds whenever they want to. Or they are convertible, which means they can be converted into stock of whatever company is issuing the bonds. Mortgage-backed securities. These are ownership of a pool of mortgages, usually issued by Fannie Mae or Freddie Mac. Traditionally, there are conforming mortgages, meaning they're regulated and they're approved by certain agencies. Recently, there's been a rise of subprime mortgages, which Fannie Mae and Freddie Mac were buying a lot of in the mid-2000s, which led to the financial crisis of 2007, 2008, because those investments ended up being terrible investments. And here is a chart of that. You can see there's been a gradual rise over the past 30 years or so, which peaked around 2008. And here is the breakdown of the fixed income market, which you can see Treasury debt makes up the majority of.
We'll move on to equity with common stock, preferred stock, and ADRs, and I'll explain what those are in a second. So you have common stock. You have some of the characteristics of common stock are ownership. Also, they're called equity securities or just equities. So each share entitles the owner to one vote on any matter that's brought up at the corporation's annual meeting, and to a share of the financial benefits of the of ownership. And you can vote by proxy by empowering someone else to vote in your name. So a lot of times, obviously, not everyone goes to these meetings. So most of the time, it's a relatively small number of people who are voting compared to like the total number of owners. The residual claim. A common stockholder is the last in line for everyone who has a claim on the assets and the income of the corporations. So they're behind all other claimants like tax authorities, employees, suppliers, bondholders, and really any other creditor. And limited liability. So the most the shareholder can lose in the event of the failure of the corporation is their initial investment, and creditors can't go after them for their personal assets. So preferred stock. So it has similar features to both equity and debt. The holder is promised a fixed amount of income every year, and this makes it like an infinite maturity bond or a perpetuity. It also doesn't give the holder voting rights. And then for fixed, the dividends are fixed as a set amount. And then they have priority over common stock. So even though the corporation isn't contractually obligated to pay the dividends, unpaid dividends are cumulative, so they add up. And the unpaid dividends have to be paid to preferred stockholders before any dividends are paid to common stockholders. And then for tax treatment, these payments are treated as dividends and not as interest, so they're not tax deductible for the firm. But this is offset by the fact that firms can exclude 70% of dividends received from domestic corporations when they're computing their taxable income. So ADRs. So ADRs are American Depository Receipts, and they're certificates traded in the U.S. markets that represent ownership in shares of foreign companies. So they can represent ownership of a fraction, one, or several shares of the foreign corporation, and they were created as an easier way to satisfy U.S. security registration requirements, and they're the most common way for American investors to invest in and trade in foreign corporations. So stock basics. So your dividend yield. Your dividend yield is your yearly dividends divided by purchase price. Your capital gains or losses are the share price increases or decreases, and the PE ratio is the price earnings ratio, or price per share divided by earnings per share. And so the stock market indices. So you have the Dow Jones Industrial Average, and so that's 30 30 large blue chip stocks, and it's been computed since 1896. It's price weighted. So price weighted average means that the Dow corresponds to a portfolio that holds one share of each component stock. So the investment in each company in that portfolio is proportional to the company's share price. And then you have the S&P 500, which is a broad-based index of 500 firms. So that's a market valued value-weighted index, and a market value-weighted index is like, so the value is calculated as a weighted average of the returns of each security in the portfolio, with the weights proportional to outstanding market value. So the total market value of all the firms and the total market value of those on the previous day of trading are used to compute the percentage increase in the index, and then you get the price. So stock market indices. So index funds yield a return equal to that of the index, but they're a low-cost passive investment strategy. And ETFs, or exchange-traded funds, are a portfolio of shares that can be bought or sold as a unit, the way you would like a single share of stock. And ETFs are varied in what they track, so they can track anything from global market indexes to narrow industry indexes. So you have your other indices, the US indexes. So the New York Stock Exchange is the market value weighted composite index of all New York Stock Exchange listed stocks, in addition to sub-indexes for industrial, utility, transportation, and financial stocks. The NASDAQ composite is an index of over 3,000 firms traded on the NASDAQ. And the Wilshire 5000 is a market value of essentially all actively traded stocks in the US. It used to be about 5,000, but now it's under 4,000 stocks. And then you have your foreign indexes from the Nikkei was Japan, the FTSE was from the UK, DAX for Germany, Hang Seng Hong Kong, TSX Canada. And then your derivatives. So derivatives is a security that gets its value from the value of another asset. So it can be commodity stocks, or commodity prices, bonds, and stock prices, or market index values. So you have your options. The specified prices in options are called the exercise or strike price. So a call option is the right to buy an underlying asset at the strike or exercise price on or before a specified expiration date. The value of calls decreases as the strike price increases. And put options, so you have the right to sell an underlying asset at the strike or exercise price on or before the specified expiration date. And as the value of a put increases, with the strike price. Sorry. And then futures contracts. So futures contract is an agreement made today regarding delivery of an asset, or in some cases its cash value at a specified delivery or maturity date for an agreed upon price, called the futures price, to be paid at contract maturity. So the long position, the trader commits to purchase the asset on delivery date, and they take delivery at maturity. And then short position commits to delivering the asset at contract maturity. So just for comparison, your options, you have the right but not the obligation to buy or sell. The option is exercised only when it's profitable, and options have to be purchased, and the premium is the price of the option itself. Futures contracts, you are obligated to make or take the delivery, and then the long position must buy at the futures price, and then the short position must sell at the futures price. And futures contracts are entered into without any cost.
Great, thank you. So I was thinking when we went through that, you guys can load up your presentation, I was thinking as we went through that, if you wanted, when you're building your portfolio, in the international class we did a global portfolio, so it excluded the US. I am willing to allow you guys to do an international portfolio. So let's say you want to do an international tech portfolio, you have to have the US in there. Okay, so it could be a global tech, US, Europe, and Asia. Maybe do a third and a third and a third, or however you want to do it. So if you want, and you would use the ADRs. Okay, So you would have to do international stocks that are traded on an exchange, okay? So if you want to do an international portfolio, go ahead and do that. Okay, I think that would be interesting to get some kind of global diversification strategy instead of just doing a domestic strategy. And then, lastly, before these guys get started, you guys have 12 minutes, so make it quick. Make it quick. Go ahead.
This is chapter 3, we're doing how securities are traded. Just a chapter overview, how firms issue securities, and then market transactions, and also rise of electronic trading, globalization of stock markets, and the market regulation. So how firms issue securities, primary markets are market for newly issued securities. They are also firms also issue new securities through underwriter to the public. And for secondary market, investors trade previously issued securities among themselves. Privately held firms have up to 499 shareholders, raise funds through private placement, lower liquidity of shares, and fewer obligations to release financial statements. Publicly traded companies, public offerings are marketed by underwriters, which are usually investment banks. The IPO is the first issue of shares sold to the general public, and the seasoned equity offering is sales of additional shares in firms that are already publicly traded. Registration must be filed with the SEC. And so you can see that this is the relationship among a firm issuing securities, the underwriters, and the public. So it starts off with the issuing firm, and it just kind of trickles down to the lead underwriter and so forth. How firms issue securities moving forward. Shelf registration. The SEC Rule 415 allows firms to register securities and gradually sell them to the public for 2 years. Shares can be sold on short notice in small amounts without incurring high or flotation costs. And then IPOs, roadshows to publicize the offering, book building to determine demand, degree of investor interest provides valuable pricing information. And then moving forward, underwriter bears price risk. So IPOs are commonly underpriced compared to the price they could be marketed. Some IPOs are well overpriced, and others cannot even be fully sold. So an example for the first two are Groupon and Facebook. How securities are traded. So there are 4 types of markets. The first one is direct search. Buyers and sellers seek each other. For brokered markets, brokers search out buyers and sellers. For dealer markets, dealers have inventories of assets from which they buy and sell. And for auction markets, traders converge at one place to trade. Bid and ask prices. So for bid price and ask price, bids are offered to buy, and then ask prices are sell offers. In dealer markets, for bid price, the bid price is the price at which the dealer is willing to buy. And for ask price, the ask price is the price at which the dealer is willing to sell. Investors sell to the bid, and for ask price, investors must pay the ask price to buy the security. Bid ask is spread. Spread is the profit for making a market in the security. Types of orders, so there are 3. The market order is executed immediately, and trader receives current market price. For the price contingent order, traders traders specify buying or selling price, and a large order may be filled as multiple prices. And then this is just the chart for the price contingent orders. You'll see the condition and the action, and then just kind of the connections with it. An example of price contingent order, you'll see like the bid and ask. So then there's the price at which they're bidding for and the size that goes along with it, and then for ask, the price at which they're asking for and the size that goes along with that as well. And this is for Facebook. And then trading mechanisms, there's 3. So dealer markets, financial market mechanism, where multiple dealers post prices at which they will buy or sell a specific security or instrument. Electronic communication networks, or EONs, are true trading systems that can automatically execute orders, and specialist markets maintain a fair and orderly market and have been largely replaced by EONs.
So how did we come to the rise of electronic trading? Well, in 1975, elimination of fixed commissions on the New York Stock Exchange. Furthermore, in 1994, new order handling rules on the NASDAQ, leading to narrow bid-ask spreads In 1997, we saw the reduction of minimum tick size from 1/8 to 1/16. And in the 2000s in the US, and share at electronic trading rose from 60% to 80%. And again in 2000, the emergence of the NASDAQ stock market. In 2001, the reduction of minimum tick size from 1/16 to 1 cent. In 2006, we saw that the New York Stock Exchange is renamed the New York Stock Exchange ARCA after acquiring the Electronic Archipelago Exchange. In 2007, we had the creation of national market systems to link exchanges electronically. Here we have a graph. It's the effective spread that's showing that the effective spread fell dramatically as the minimum tick size fell, which basically means that the bid price to actual sell price decreased as the minimum amount you could bid on an item rose. So now we have the U.S. markets, the New York Stock Exchange. The New York Stock Exchange is the largest U.S. stock exchange. Automatic electronic trading runs side by side with broker/specialist systems, as measured by the value of the stocks listed on the exchange. The SuperDot is the electronic order routing system, and the Direct Plus is the fully automated execution for small orders. Specialists handle large orders and maintain orderly trading. The NASDAQ lists about 3,000 firms, originally a dealer market with a price quotation system. Today, the NASDAQ's Market Center offers a sophisticated electronic trading platform with automatic trade execution. ECNs are private computer networks that link buyers with sellers for automated order execution over multiple exchanges, and they compete in terms of the speed they can offer, which refers to the latency, the time it takes to accept, process, and deliver a trading order. Major ECNs include Direct Edge, BATS, the New York Stock Exchange and the New York Stock Exchange ARCA. So we also have is the algorithmic trading, the use of computer programs to make trading decisions, high frequency trading, special class of algorithmic with very short order execution times, dark pools, trading venues that preserve anonymity, mainly relevant in block trading. New trading strategies, bond trading. Most bond trading takes place in the OTC market among bond dealers. New York Stock Exchange bonds is the largest centralized bond market of any U.S. exchange. And the market for many bond issues is thin and is subject to liquidity risk. Globalization of the stock markets. Widespread alliances and mergers. The New York Stock Exchange acquired Archipelago, American Stock Exchange, and merged with Euronext. International Exchange, ICE acquired the New York Stock Exchange, Euronet. The NASDAQ acquired Instant, INET, ECN, Boston Stock Exchange, and merged with OMX to form NASDAQ OMX Group. Chicago Mercantile Exchange acquired Chicago Board of Trade and New York Mercantile Exchange. The biggest stock markets in the world by domestic market capitalization. So you see that the NASDAQ, the New York Stock Exchange, is by far the largest in the amount of trade it produces. Korea being down there at the bottom. Trading cost, brokerage commission, fee paid to broker for making the transaction. Explicit cost. This is the explicit cost of trading, full service versus discount brokerage. And then we have the spread, which is the difference between the bid and the asked prices. Implicit cost of trading. Buying on the margin. Borrowing part of the total purchase price of a position using a loan from a broker. Investor contributes the remaining portion. And the margin refers to the percentage or amount contributed by the investor. You profit when the stock rises. Buying on the margin. Initial margin is set by the Fed, currently 50%. Maintenance margin, minimum equity that must be kept in the margin account. Margin call if value of securities falls too much.
So we have a breakdown of margin trading. Initial margin is the percent you put down. Maintenance margin is what they loan you. And so we have here share price is $100. Shares purchased is 100, so stock's worth $10,000. You borrowed 4,000 of that, and you own 6,000 equity of it. But at the the stock price falls to 70%, now the stock's only worth 7,000. You still borrow 4,000, you got to pay back. You still have 3,000 in equity worth in the stock. So, how far can the stock price fall before a margin call? Maintenance margin is 30%. Just going through the equation of this, equity is at 100 price minus 4,000% margin is your capital gains basically, which would make be 30%, and then you solve to find the P, which would be $57.14. And now short sales. This is when you think a stock's going to decline in price. So initially you'll to profit from the decline in price of a stock or a security. You borrow a stock, so you start at a stock that's worth 100, and you're hoping it'll fall to 90, and then you'll rebuy the stock and give it back to the loaner at 90. So you made a $10 profit on that stock or on that share. Closing out the position, buy the stock, and return to the party which was borrowed. It's sort of risky because usually the stock market goes up, but feeling. So your short sale mechanics. At the initial start, you buy a share at the initial price. At the second time slot, you receive a dividend, sell share, and you get the ending price plus the dividend. The profit can be calculated by finding the ending price plus the dividend plus initial price. And then when you short sale, you borrow the share and sell it, like I said, and then you just try to repay the dividend and you buy a new share at a lower price, hopefully. If it goes up, then if the stock price goes up, then you lose money. So here's a breakdown of a short sale. 100,000 or 1,000 shares. Initial margin is 50, maintenance margin is 30%. Initial price is $100, and the sale proceeds is going to be $100,000. The margin of equity you owe is 50,000, and the stocks owed are 1,000 shares. Short sale, dot bomb, that stock falls to $70 per share. You have $100,000 already because you already sold the stock at its price, original price, and so now you still have to buy $70,000 of stock to pay back the loaner. So your liability is $70,000. You'll end up with a $30,000 profit because you were able to save. You're able to buy back the stock at a much lower price. So you can see in the calculations there. And here's another capital gains calculation. Just the original price minus the current, 30 divided by the current again, 30,000%, or 30%, sorry. And then the price would be $115.38.
So why don't we finish that on Wednesday?
Okay.
And then, go ahead, and then on Wednesday we'll do the chapters 4 and 5, and we'll work on the problems. And then chapter 1 was just talking about the financial crisis. The financial crisis blew out the capital market.